Well, stocks have generally been rallying since the Fed meeting last week on hopes they're done hiking rates, especially as inflation levels have come down sharply. But the Wall Street Journal says the Fed shouldn't get credit for that drop because the best we can say about the Fed is that it stopped things from getting even worse. So what should we make of the Fed's policy moves? And is the market correct in expecting that rate cuts come next? Let's ask David Zervos, chief market strategist at Jefferies, and CNBC senior economics reporter Steve Liesman. So glad you could both join. Steve, let me just start with this, with the article, kind of set us up a little bit in terms of the debate that's out there on the street. I don't think there's any doubt, really, that the Fed's hikes certainly helped break the back of high inflation. It's just I think consumers want to see even more relief on the price level than what we've seen.
Yeah, you hit that term exactly right. Consumers want the price level, and the policymakers are going for the level of increase or the rate of increase of prices. So there's a bit of a difference in terms of the goals there. Look, I get where the journal is coming from on this article, and a lot of it makes sense in the sense that we have had stronger growth and inflation has come down despite that stronger growth. And in some areas, it hasn't been as much change as you would have thought. I think the context is really important here. The Fed went into this fight against inflation with at least one hand tied behind its back, and that's because two of the areas that it has the most impact in most times when it's hiking rates, autos and homes, were areas that were in extreme deficit relative to the supply that should be out there. We know we've been underbuilding homes for a long time. We know there's a huge demand for it. And on top of that, the demand for housing, the unique demand for housing that came out of the pandemic, which is for those homes where you could have an office in there. The other thing is cars were down, and there was a big problem in terms of getting the automobiles and in terms of supply. So while the Fed was trying to tamp down on these areas, and the two areas it actually have the easiest impact on, there was incredible demand for both of these products on the other side. So to the extent that it has had an effect, it's done so with a tide running against it.
And Dave, a lot of people have been looking for relief on that front, for an end to rate hikes and maybe some moderation in mortgage rates and so forth. But you're warning people not to get carried away, as they have over the quarters, with this idea that cuts are coming. Why not?
Well, honestly, Kelly, it's the same story we've been telling since the beginning of the year. People at the beginning of the year were forecasting rate cuts in September. And clearly we're here in November still debating whether they're going to hike one more time. So I don't think the argument's changed much. It's been an argument that, we framed as the Fed really not being as restrictive as maybe the rates market would suggest because of the size of the balance sheet and a few other factors related to the strength of the consumer. But to go back to Steve's analysis and the article that you referenced, I think it's a really interesting article and a really interesting time to debate what's in there, because I do believe the article has some good points in that it probably wasn't so much the Fed that brought inflation down. We've had very strong growth and one of the fastest disinflations in post-World War II history. I think the third fastest, only to be surpassed by the deflations or disinflations of 75 and 82, which were both pretty bad years economically. So it is a very interesting story, but I think it's rooted in the whole idea and the misconception that the inflation itself was the Fed's fault. So I think you have to take that article back. And if you're not going to lay blame for or credit for the Fed on getting the inflation down because of supply side stories and supply side logistical issues that were related to the reopening, I think you also put the same supply shock in play for the inflation that we got between Q2 of 2021 into the summer of 2022, which the article is not doing, and most of the critics were not doing. And I know you want to get back into a couple other things, Kelly, but I want to go back and put criticism where I think criticism really is due, and that's with all the folks in the summer of 2022 who were criticizing the Fed for being too late,
right,
and generating all of that inflation when it really was a supply shock story. The Fed staying on top of it and keeping inflation expectations anchored, as Olivier Blanchard said in the article when he was quoted. But most importantly, the big miss was all of these folks at that Brookings conference. I think it was a Larry Ball paper and Jason Furman commenting on it that talked about how the unemployment rate was going to have to go to 6.5% for 2 years just to get inflation back to 2 or 3%.
Yeah,
that's clearly been the biggest miss of this entire thing. And that's where the criticism should be, is that we didn't have to crush demand to get inflation down because this was a supply shock to begin with.